Real estate investment trusts are commonly perceived to be boring income investments, and as a result, many think that they're only suitable for retirees. The reality is very different. Yes, REITs pay a high yield, but real estate is a total return investment with growth and appreciation making up a large portion of the total return. If you look at past multi-decade time periods, REITs have very often outperformed the broader stock market, including the S&P 500, earning double-digit total returns ranging from 12 to 15% depending on the time period. And the reason why REITs have been so rewarding is because yes, they pay a high dividend yield, but they've also been able to grow this dividend by hiking their rents and acquiring additional properties at a positive spread over the cost of capital. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to talk to you about 3 of my favorite dividend growth REITs to buy today. But before I get into it, I want to remind you that we're still offering a 2-week free trial for my REIT newsletter, High Yield Landlord. So if you want to access my entire portfolio as well as my transactions in real time, please check out the first link in the description of this video. So the first REIT I'm going to talk about here is called NNREIT, ticker symbol NNN. This is really an easy pick for this list because it has one of the longest dividend growth track records in the entire REIT sector at 34 years. This is even longer than the dividend growth track record of Realty Income, also known as O-Stock. Not only that, but it has also earned roughly 12% average annual total return since going public a few decades ago and massively outperformed the broader stock market, including the S&P 500. And I think that NNREIT is well positioned to keep delivering similar total returns going forward because its valuation is historically low, its dividend yield is historically high, and the REIT is well positioned to keep growing going forward. Historically, the REIT has grown its FFO per share and its dividend per share by about 5% per year, and I think it's well positioned to keep producing similar growth going forward, given that it owns mostly service-oriented net lease properties such as Taco Bell restaurants, and all these properties are under very long triple net leases. Today, its average lease term is over 10 years, and so its future cash flow should be highly consistent and predictable. These leases also include annual rent escalations of about 2%, which may not seem high, but you need to remember here that these are triple net leases, so the tenant is responsible for all property expenses, including even the maintenance. So 2% annually, very consistently, really adds up over time and flows directly to the bottom line. Then on top of that, NNREIT also retains about 40% of its cash flow to keep acquiring additional properties. And finally, it has a fortress BBB+ investment grade rating with a low LTV and long debt maturity, so it's not heavily impacted by the surge in interest rates. All in all, I think that it's quite likely to keep delivering about 5% of annual growth on average. This doesn't mean that it's going to grow by 5% every year. In fact, this year it's going to be a bit lower than that as it's refinancing some of its debt, but on average it should be able to keep growing by about 5% per year. And when you add that to its current 5.5% dividend yield, you get to double-digit total returns, slightly above 10%. But it doesn't even stop there. As I mentioned earlier today, NNREIT is priced at a historically low valuation multiple of just 12 times FFO. Not long ago, before this recent bear market, which started in 2022, it was priced at closer to 20 times FFO. That might have been a bit much for NNREIT. I don't think it's going to reprice at 20 times FFO, but if you now expect interest rates to start going lower over the next year, I think it's quite realistic that we see NNREIT being repriced at closer to 15 to 16 times FFO. And so if you think that this is going to happen over a 3 to 5 year time period, that should get your total returns closer to 12 to 15% per year going forward, which is very attractive in my opinion, coming from such a defensive, lower risk blue chip type REIT like NNREIT, which has a 30+ year dividend growth track record. Then the second REIT I'm going to discuss now, I think could be potentially even more rewarding, but it's also a bit riskier. It's called VICI Properties, ticker symbol VICI. This is a newer REIT that came public in 2019. It focuses on riskier properties, but they enjoy even faster rent growth. This is the biggest casino REIT in the world. It owns some of the most iconic casinos on the Las Vegas Strip, such as the Caesars Palace, the MGM Grand, the Venetian, and many other casinos that you might be familiar with. And in the 5 years it's now been public, it's been able to grow its dividend per share by about 7 to 8% per year, so quite a bit more than its peers like Realty Income and NNREIT. And it's been able to achieve this because its leases are even stronger. Their terms are even longer at 40+ years in most cases, and importantly they include CPI-based rent adjustments, and so this is leading to faster rent growth, especially during times of high inflation, such as what we've experienced recently. And then the second reason why VICI has been able to grow so fast is because historically cap rates in the casino property sector have been quite a bit higher, and so this has allowed VICI to pick up properties earning higher spreads over its cost of capital than its peers. Last year, the REIT again grew its FFO per share by about 10%. And this year, despite having to refinance a bunch of its debt at higher rates, it's still expecting to grow its FFO per share by another 4%. And just like NNREIT, VICI's share price is today also heavily discounted. It's priced at just 11.5 times FFO, which is a historically low valuation multiple for the REIT. And its dividend yield is also historically high at 6%. And so really here, all it takes is 4% of annual growth for it to reach double-digit total returns. But because of simple math, 6% plus 4%, you get to 10% if you assume that the dividend yield remains intact and the valuation multiple doesn't change over time. But just like NNREIT, I think that VICI is likely to also enjoy some FFO multiple expansion in the coming years as interest rates return to lower levels. And all of these combined together, coupled with perhaps a bit of faster growth in the coming years, could result in up to 15% annual total returns going forward. Such high returns may seem unrealistic coming from REIT, but these returns are actually in line with what VICI has achieved since going public about 5 years ago. Hey, before I go into the third REIT, can you please do me a huge favor and click the like button? That helps me a lot to grow this channel. Thank you very much in advance. And also subscribe to the channel if you don't want to miss future updates on any of these companies. The third REIT I'm going to discuss now is rarely included in the lists of dividend growth companies, and that's because it's such a high yielder. It's offering a 9% dividend yield, and the name of this REIT is New Lake Capital Partners. Its ticker symbol is NLCP. But the interesting thing here is that despite offering such a high dividend yield of around 9%, the REIT has actually managed to hike its dividend in nearly every quarter since going public. And I think that its strong growth is set to continue in the coming years because of the following reasons. The first reason is that it owns mostly cannabis cultivation facilities in limited license states, and so they are strictly limited in their supply, but the consumption of cannabis keeps on growing. Then the second reason is that it enjoys very long leases with over 10 years on average left on them, and these leases also include 2.7% average annual rent escalations, and the tenants are responsible for all property expenses including the maintenance. The third reason is that REIT today has no debt. However, it has secured a credit facility with a 5.65% interest rate that's valid till 2027, and it could deploy all of this capital today into acquiring additional properties at a roughly 12% cap rate. So there's a massive spread in there that would very significantly expand its FFO per share. And then the fourth and final reason is that the REIT is also retaining about 20% of its cash flow to buy back its own stock, which is also very accretive to its FFO per share. This explains why the REIT just recently hiked its dividend by another 2.6%, and I expect another similar hike later this year. And so if you're now getting a 9% dividend yield and you add to that about 5% of annual growth, you're getting to near 15% average annual total returns. And then on top of that, the REIT is today priced at a historically low valuation multiple, less than 10 times its FFO. If you think that interest rates are going to go lower in the coming years, and perhaps the market is also going to warm up again about cannabis stocks, if some legal changes are implemented, then this REIT could see some FFO multiple expansion on top of its dividend yield and its growth. And in total, this could lead up to 20% average annual total returns. Obviously, this REIT is also riskier than NNREIT and VICI properties, but the risk reward is very attractive in my opinion. So NNREIT, VICI Properties, and New Lake Capital Partners are 3 good examples of dividend growth REITs that should be capable of delivering double-digit total returns going forward, and they're really the proof that REITs are not just boring income investments that are only suitable for retirees. Today they are particularly attractive because they are priced at high dividend yields, historically low valuations, and yet their fundamentals remain strong and they keep on growing, and they are by no means exceptions in the REIT sector. And if you want to access my entire REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter for a 2-week free trial. I'll put a link to it in the description of this video. As I've said before, this is a real 2-week free trial. You won't be charged anything in the first 14 days. So if you want to come in and just see my portfolio and then cancel, it's perfectly fine with me. And otherwise, once more, if you could please click the like button, that really helped me a lot to grow this channel. Thank you very much, and see you at my next one. Bye bye.